Assalamu alaikum. Bismillahirrahmanirrahim. All right, so we're going to start with this subject of ACCA, which is called F8, Audit Assurance. It's also called AA. Okay, so I'll give you an introduction about the subject, and then we're going to start with our chapter number 1. So this exam is of 100 marks. And it's a 3-hour paper, which will be conducted on the computer. So it is a computer-based exam. You will have 3 questions of 10 marks each. And these will be objective style questions. So you'll have a scenario, and then you will have maybe 5 questions related to that scenario of 2 marks each. So it will be more like MCQs. Then the section B, this is a 70-mark section. It consists of 1 30-mark question and 2 20-mark questions. So these are going to be written questions, so long written questions. So you will have to type the answers. So that's how the paper is going to be. Now let's talk about audit. What does it mean to audit? So if we use this word very generally, it means to check something, to inspect something. So when we talk about audit in the context of business and companies, it is a legal requirement of companies to get an audit in most parts of the world. In most of the developed and developing countries, companies have to get an audit. It's a legal requirement. So even in UK, it is required by Companies Act 2006. If you're a company, of course, if you can get exemptions for small companies, but if you're a company, you have to get your accounts and your financial statements audited. So why exactly do companies need to get their financial statements audited? So it's a long story. Initially, businesses were small businesses. They were small and they were local in nature. So you'd have like one owner, or if you had multiple owners, it would be a family-run business. But in 1900s, companies became very popular and people started forming companies so that, they have limited liability for the business and their personal assets would not be at risk. And then the companies started growing in size. When the company started growing in size, the owners of the business, they needed more investors. So then the stocks started selling to the public on the stock exchange. Now, if you're an investor in a company, you would want to know how well the company is doing. Why would you want to know how well the company is performing? To make decisions. So investors need some information to make decisions regarding their investments. Or if you're a bank and you have to lend to a company, you would want to know how well the company is performing. So for that, companies make financial statements. So since you've already covered financial statements, you do know that the two most important financial statements are statement of profit and loss and statement of financial position. And of course, in the old days, only financial statements were published by companies, but now if you look at the annual report of companies, it contains a lot of other information as well. So it contains the financial statements and it contains the other information. So other information includes information such as the corporate social responsibility report, the corporate governance report, report on ethics, the structure of the board, environmental audit, and so on. So I'm assuming because you've already done F7 and F3, you would be aware of all of these concepts. Now, these financial statements were being used by the investors or the banks to look at how the business was or how the company was performing. So if the company was performing well, they would get more investments. So more people would buy shares of such companies. Now, the problem was that a separation of ownership and control took place. Why did that happen? The companies became so big, they had so many shareholders. So shareholders were hundreds and thousands and, even in some cases, millions in number. Now, if all of these shareholders are the owners of the company, it is not possible for them to come to the office and run the company. I mean, I'm sure you've heard the phrase, too many cooks spoil the broth. So it was not possible for all these owners to come and run the company. So, as need be, the ownership and control had to be separated. And how was this done? The ownership was with the shareholders, while control was handed over to the directors of that company. Now, all the important financial decisions were being taken by the directors, but these are not the people who they're elected by the shareholders and they are managing the company, but they're not the owners. Now, the directors, in order to get their bonuses and their increments and a promotion, they would show information to the shareholders, which was maybe window dressed. So they made the information, financial information, look more attractive and more pretty. They made it more pretty. But was this information objective? Not really. Was it reliable? Not really. And hence, a lot of huge corporate scandals took place. For example, the Enron scandal, where billions of investment was lost by the shareholders because they were relying on the financial statements of the company, and those financial statements were not giving a true view of the financial performance and state of that company. So, to avoid that, it became necessary that the financial statements that are the responsibility of the directors to prepare, they had to be audited. Now, if these financial statements were being audited by the directors themselves, so the issue would be they would be reviewing their own work. And if they review their own work, they would obviously say that the financial statements are giving a true view. So then the law decided that these financial statements would be audited by an independent third party. And that independent third party was called external auditors. And how were these external auditors independent of the company? They were not the employees of the company. So these are the people who would then report on the financial statements. They would issue their audit report after checking the financial statements, whether the audit report was giving a true and fair view, so that the users of the financial statements or users of the information which is being published by the company can have confidence in the information that is being given to them. So that's like a brief history of why audit started. So this is exactly what is written in our study hub as well. So here they're talking about statutory audit. Statutory means which is required by the law. So in UK Companies Act 2006 requires that companies have to be audited. So that's why it's called statutory audits. But in the initial years, the aim of audit was to detect fraud, technical errors, and errors in principle. But since companies kept on growing in size, and you can see that nowadays companies are these multinationals and these conglomerates, they're huge companies and they're spread across the globe. Like if you talk about Nestle is operating all around the world. You will find Nestle in US, you will find Nestle in UK, you will find Nestle in Pakistan, in developing countries, and also in third world countries. So the businesses grew so much that it was not possible now for auditors to give 100% accurate report on the financial records, because they could not practically go and check, because now the companies are located in all these different parts of the world, and they're doing their business in all these different parts of the world. It was not possible for the auditors to check everything, which is why now when the financial statements are audited, the auditors are giving an attestation or they are giving a testimony of the credibility of those financial statements, but they are not giving 100% assurance that these financial records are completely free from any error. So that was a brief introduction to external audit. On the other hand, we have internal audit. So internal audit, if you even look at the name, is when the company's accounts are audited internally. So when we say internally, we mean by the employees of that company. So internal audit is done mostly, it can be outsourced to a third party, but it's mostly done by the employees of the company. Most large companies have their own internal audit department. What exactly are internal auditors doing? They are checking whether the accounts and the financial statements are prepared according to the criteria which is required. So, for example, if they're prepared according to the IFRS and international accounting standards, then they also check whether the controls in the organization are being they're being followed by the employees and not being bypassed. They check all the operations are being done according to whatever SOPs were established for that organization. They make sure that laws and regulations that are applicable on the business are being complied with. And who do they report to? So internal auditors, they report to. Now, the problem was that to keep these internal auditors independent, they if they reported to the directors of the company, they would not remain very independent, right? Because directors are the people who are responsible to set up the internal control system of any organization, right? They are responsible for the controls, they are responsible for the financial statements. And if they are reporting to the directors who are their own bosses, they will not remain that independent. So, from the board of directors, a committee is formed, which is called the audit committee, which consists of non-executive directors, and these are independent of the board of directors. They're non-executive directors who report directly to the shareholders. So the internal auditors report directly to the audit committee. That's a way of keeping them independent. So talking about your internal audit, it is not a statutory requirement, but it is required by UK's Corporate Governance Code. We will discuss Corporate Governance Code in detail when we'll discuss it in chapter number 14. So because companies became bigger and the operations became wider and bigger and more complex, it became very important for the internal auditors to keep a check on all routine financial and operational functions of that organization to ensure that compliance with law is taking place, the assets of the organization are safe, to ensure the security of the organization, and to detect fraud in case if fraud is taking place. And in the Institute of Internal Auditors was founded in 1941, which trains internal auditors how to do internal audit. For some funny reason, my screen is kind of stuck. All right, so the next topic is assurance services. So what exactly is assurance service? So assurance service, when we were talking about external audit, that's an assurance service. So assurance service is when independent professional service is given to a company to improve the quality of information for the decision makers. So when a third party, an independent professional third party, gives an assurance that the financial statements or the information which is being provided in the annual report is giving a true and fair view, that's an assurance for the users of that financial information that this information is reliable and they can base their decision making on that information. Now, why has assurance services increased, the demand for insurance services increased in the past few decades? So, one, that businesses initially, you know, that when industrialization took place, it was the era of industrialization, and the focus was on um, uh, making the industry and the factories automated and using a lot of capital assets and using machinery and plant and equipment and training your workers how to use it. So that was the era of industrialization. But now it's the era of information. Now, most of the businesses, when they are taking decisions or when people are taking decisions regarding businesses, they do it based on information. And initially, information was not readily available to people. But now, with the advent of uh, information communication technology, information is readily available to everyone. So even if I'm sitting in Pakistan right now, I can get the financial statements of a company, a public limited company in the US, or I can get the financial information of a company in the UK. So now information is very accessible. So the problem is that when a lot of information is available, you have a lot of information to take decisions, you also need to be sure that the decisions you're taking based on that information also needs to be reliable information. Then the needs of information for businesses have also changed. So it's not like the information maybe 50 years back. The consumers did not want a lot of information about the business. I mean, they had needs and wants, and the consumers wanted their needs and wants to be fulfilled, but they did not require a lot of information about the business. But nowadays, the consumers are also very well aware, and the consumers want to purchase from businesses that are ethical businesses or environmentally friendly businesses or green businesses. So even consumers want information about a business. So the need of information is changing. Then there's an increase in the demand of relevant information for decision makers. So decision makers, when they want to take decisions about a business, they want to go through budgets and cash flow forecasts and so on. So for example, if the decision maker is a bank and they have to decide whether to give a loan to the company or not, they would want to go through their budgets and their cash flow forecast, and they would want to know whether this company in the future would have enough cash to pay us back our loan, the principal amount, and the interest as well. Then there are emerging technologies. Because of technology, the internet and the automation of how information is collected, there is a lot of information available for businesses. So a lot of your information is collected automatically, right? So even when we're using Facebook and we're using social media, our information is constantly being collected by these companies, and then they're sold to businesses. So a lot of information is available because of new technology. So that information also has to be checked, and it has to be made sure that that information that is accessible should be reliable as well. Then there's changing expectation and demands of customers, suppliers, and other stakeholders. Now, all these stakeholders want to know about what's happening, the quality, the market trends. So they now, like even the suppliers want to do business with companies that are ethical and are not doing something which is unethical. We have seen over the past few years that a lot of companies were boycotted by customers. Like KFC had, I think, around 500 and something, 570 branches in Turkey, and they all shut down because people in Turkey completely boycotted KFC for supporting the genocide in Gaza. So yes, the demands of the customers are also changing. The customers want to buy from businesses ethical businesses, and they want that information about businesses as well. And then globalization has taken place. Businesses have become like the businesses are operating in an environment which is a global marketplace now. So now you can sit in a country in Africa maybe, and you can order something from Australia, or you can sit like if we look at Amazon, they're delivering in all parts of the world. So the point is that businesses now they have worldwide needs, and they need to make sure that they have an ethical supply chain as well. So again, information is required for that. And then increasing corporate accountability also demands that relevant and reliable information should be available. It is also now a requirement of not of law and regulation, and also corporate governance. Principles of corporate governance also place a lot of emphasis on the information being provided to the users, that it should be very relevant, it should be very reliable. So the typical assurance services that are given by audit firms could be audit of financial statements, where you would review the historical information provided by the company. Then prospective financial information. So prospective is related to the future. So if cash flows are made by the company in order to maybe secure a loan by a bank, so that is future information that they're providing, something that has not occurred as yet. So future information also has to be based on some concrete information and that took place in the past, right? So to make sure that it's reliable, such services can be requested by the company. Then business ethics, audit, social responsibility reporting, and environmental reporting. Now, businesses, we have done integrated reporting in FBT, F1, and you must have done integrated reporting in F7, F3 as well. So integrated reporting requires not only to report on the financial capital of the company, but also on how the human capital is being used, how the environmental capital is being used. So now businesses have to report on how they're being socially responsible. They have to report on how they are, what code of ethics are they following in their company. They have to report on what is their impact on the environment. So they have to do environmental reporting as well. So assurance service can be taken to make sure all these reports that have been made by the company or provided by the company are giving reliable information. Then assurance can also be, service can also be requested for risk assessment of a company. Then value for money audits can also be done. So to see if you are investing somewhere or you're buying a property, so is it value for money or not? Then performance measurement and systems and control reliability. So whether the systems that have been established in the company and the control system that has been established in the company is reliable or not. So these are the different types of assurance services that can be provided by external auditors. So I think that's it for today. Inshallah, tomorrow we will continue with this chapter. Tomorrow we will do another topic. Wait. So we will do, we will start with external audit and an introduction to external audit, and we will do external audit in detail. Okay, I'll see you guys tomorrow. That's it for today. Bye-bye.